Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Brian, I think it's pretty safe to say that markets have been just moving whipsaw on the headlines that are coming out. It really is around the Fed, inflation, and COVID variants that are driving the direction.
Yeah, we've seen a great amount of volatility, especially over the last few weeks, ever since that Friday after Thanksgiving. I would argue it started right at the highs of the year, which was that Monday when the S&P and Nasdaq-100 made 52-week highs, but then in that same session reversed sharply lower. We saw some very short-term bearish patterns there on the daily candlesticks, and we haven't yet recovered those new highs. And we've seen a lot of distribution underneath the hood of the surface, and more stocks making 52-week lows. And as you noted, COVID has been a factor. The responses to COVID has been a factor, obviously. The travel restrictions, increasing lockdowns globally, and then we have the Fed here, who is responding to the very steep inflationary data that's been coming out, and they're pivoting to a much more hawkish response with the tapering going from 15 to 30 billion a month, which we're already a couple weeks away from the start of the next year. So that tapering is going to be complete by March, right, at this pace, and then shortly afterwards the market is looking for the rate hikes.
Right. But Brian, it's so interesting. The Fed has been incredibly clear telegraphing their policy. There was not kind of an aha or gotcha moment in the release, yesterday on Wednesday. It doesn't feel as if I felt like right around Thanksgiving when Powell got a little bit more hawkish, that sort of surprised the markets a bit. But yesterday, we saw the reaction after his meeting and the presser. I mean, the markets just took off. The Nasdaq-100, we'll look at the technical levels in just a minute here, was actually the least of performing of the major averages. And then once he got through his press release, it finished up, the top index of the day. It seems as if almost, okay, the news came out of the system, sort of official, it's out there. And traders kind of took a sigh of relief, like, okay, no surprises. We just waited for it to officially come out.
Yeah, and markets are always looking ahead and anticipating. So yesterday's announcement, as you noted, was in line with what many people were expecting. Even I was expecting that, and but I'm following, actually, the experts, in the field, and so that was very much in line with expectations. But a lot of stocks had already been sold off quite a bit. If you looked at the Russell 2000 as of last Friday's close, the index was down 10% from 52-week highs, but the average stock was down 35%, and the median stock was down 25%. So if you look underneath the hood of the index, we have been seeing, a pretty considerable amount, depending on market cap, but especially amongst those small caps, we've seen a considerable amount of corrective price action underway for quite some time now. It really depends on which industry you're looking at, which sector, and what I think yesterday's reaction was just, hey, it could have been worse. The Fed made some comments, Powell made some comments that they were not necessarily looking to just stop the repurchase program right away. They were mindful of markets, and they felt a gradual process was better. So maybe that little bit of commentary could have been, the sale, the win in the sale of yesterday's rebound. But, it's a very short-term move. And we're seeing today, a lot of that move completely unwind.
All right. With that said, let's pull up your Bloomberg here. Take a look at the Nasdaq-100 and levels that you're watching.
Yeah, and so right here, we're looking at the daily chart of the Nasdaq-100. You can see here's today's candlestick. It's completely engulfing the body from yesterday and the prior day's range. So, certainly, a one-day bearish move here. We gapped up higher, and now we're trading right around the lows of today's session. So if we hold around here on the daily frame, that's certainly a concerning move. We've been in this sideways choppy range. Longer term out, the weekly period chart, we are still holding this uptrend. So it's hard to get too bearish when we see this uptrend is still intact. We're holding above the prior high made back in September. That is an expected support level. Will that hold? That remains to be seen. this is the week from 4 weeks ago that we've been highlighting, the week of Thanksgiving, where the Nasdaq-100 and the S&P 500 made 52-week highs, but then we finished at the low end of the week, and then the following week was down. So there's your bearish confirmation. Yet last week we did rebound off support, but we're lower again this week. So there's some mixed messaging here. The longer term trend is definitely still to the upside. If we were to lose this uptrend, then I would be more concerned. If we look at the S&P, the Spider Technology ETF, so technology makes up approximately 50% of the Nasdaq 100. This week it made a new 52-week high. We've been in a strong uptrend here. So again, this sector, it's hard to get too bearish on it at the moment based on the ETF's performance. Certainly many individual stocks within the index, have seen some pretty significant declines, but this index, this ETF, just this week on Monday made new highs. So we are seeing a slight bearish divergence, but you're always going to see that over the very short term. I would just note that the ratio of growth over value, this is a pretty significant, a potentially significant inflection point here in this index. So this is a monthly period chart of the ratio of growth over value. Many of the growth stocks are within the Nasdaq 100, and we could see back in August of last year, it made a significant top well above the highs we saw in 2000. It pulled back in November through May of 2021, and that was when the working from home trade transitioned to the return to work trade, and different stocks took over leadership. And then over the last few months, this resumption of growth over value has been underway. We broke out as of the end of November to a new all-time high, and notice the momentum has stalled significantly. So we're now pulling back in December. In December, we're seeing the defensive stocks, the defensive sectors outperform. This month's top performers are staples, utilities, healthcare, and REITs. So we'll see what this means. Is this a significant, major turning point in growth over value? Kind of early to say, but certainly has the potential. The monthly RSI reached 93 back here in August of 20. That was an all-time high. If you looked at the weekly RSI, it came out to about 89.90. That was also an all-time high. So certainly you could argue here this uptrend, which really was the working from home move, working from home trade, where growth significantly outperformed value by a significant margin. It'd be interesting to see if this is a significant top, and value maybe next year could be the sector, or the types of the value versus growth could be the outperformer.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.